From New York City for our viewers worldwide, I'm Lisa Abramowicz in for Jonathan Ferro. Bloomberg Real Yield starts right now. Coming up, investors keeping an eye on the G7 summit in England, with Treasury yields heading for their biggest weekly decline in almost a year. This comes despite another upside inflation surprise in the United States this week. We begin with the big issue, the bond market joining the great inflation debate.
The bond market is telling us that inflation is transitory.
Finally, markets are trusting the Fed.
We're in a Goldilocks period and everything's going to be great.
These transitory price moves.
Double-digit increases in airfares and hotel costs.
The airfares, the used car prices, et cetera.
It was all a question of when they were going to actually peak.
Look at sort of contagion into other components.
The biggest risk is if we start to see wage pressures go up sustainably.
That is the critical moment.
Everybody's screaming there's no inflation.
There is some inflation here that's going to stick.
I don't see a bond market yet reflecting that there's transitory inflation.
No, I don't agree.
It really doesn't matter if inflation is transitory or persistent. It matters what the Fed thinks.
That's really where the debate is in the market.
Joining us now, BlackRock's Marilyn Watson, JPMorgan's Bob Michael, and Jean Tannuzzo of Columbia Threadneedle. I'd like to start with you, Marilyn. The question that I have, starting before we even get into the great inflation debate, is can we even get any message from the bond market, or is this purely a reflection of Fed policy and their buying of $120 billion of bonds every month?
Well, I think it certainly is partly a reflection of the Fed policy and the central bank policy. But I think it is also, as you heard from the snippets just now, I think it is a reflection that many market participants do think that inflation is transitory, and that the data we're seeing, whether it's from the University of Michigan or it's the CPI data, that it is transitory. The question will be, how transitory is it and over what time period? But I think the bond market is telling us that they don't expect too much from the Fed. Next week, they're expecting the Fed to start talking about tapering. I don't think we're expecting anything concrete. And certainly in terms of the messaging from the Fed, I think the market really is pretty sanguine in terms of expecting them to really not announce too much in terms of certainly interest rates. So I think the bond market is telling us that they do think, to a certain extent, inflation is transitory for now. It's going to be very, very data dependent. And so for the time being, they're still focused. Investors are really focused on really trying to just get that carry locked in, the yield carry in, for the foreseeable future. Bob, is the bond market right?
Well, I think the bond market is 99 and 99/100% the Fed. I don't think anybody in bonds believes, with the amount of growth and inflation that we have, that accepting a minus 90 basis points real yield on the 10-year Treasury makes any sense at all. And when you listen to people speak, you would think that the 10-year Treasury was 2.5% to 3%. It's nonsense. The Fed is keeping it here. Nobody in the bond market wants to own it unless they have to. And every so often, the shorts get frustrated and just get squeezed out. And that's what we saw yesterday.
All right, Jean. So just a short squeeze, no real message here. Do you agree?
Well, I do think there's a short squeeze going on, Lisa. I think we talked a couple of weeks ago and we discussed the fact that probably the biggest risk for the bond market was lower yields because the market was positioned very short. So I think Bob's very much right about that. But, from an inflation standpoint, I think the market is sending a message, and it's sending a message that, if you look over the last year, almost the entirety of the yield increase has been in higher inflation expectations. It has not been in higher real yield. And I think it's really incumbent on the Fed to pivot policy to see real yields move much higher at this stage.
So there's a question, Bob, if you're right, and the market really is not a good barometer of how people actually believe, is it ripe for a potential surprise? Could we end up with a sudden rise in Treasury yields? Or is this going to just be a situation where yields remain where they are with their Fed on the thumb and with their thumb on the market, and that's that?
Well, bond yields are anything the Fed wants them to be. And right now they want the 10-year where it is. And if you want to co-invest with the Fed at this point in the cycle, if I can go back to what Bob Merton said decades ago, that's the equivalent of picking up nickels in front of the steamroller. So yeah, at some point the Fed's going to come out and say, hey, you know what? There is a lot of growth. There is a lot of inflation. these levels are ridiculous. We're going to start tapering. We're going to start raising rates. And a lot of holders of debt are going to get flattened.
All right, so this is one issue that Priya Misra raised, TD Securities, saying that shorting the 10-year ahead of next week's Fed decision might be the way to go. She writes, quote, the median 2023 dot is likely to move higher, and the Fed can start talking about the conditions and timing of its exit. This should come as a surprise to markets, which are priced for a dovish Fed. Marilyn, do you agree? Do you think that the market is set up for a surprise and that you could see yields rise materially after next week's Fed meeting?
I'm not so sure that we'll see yields rise dramatically following next week's Fed meeting. I do think they will continue to drift higher, and I think certainly going towards the end of the year, we will see the 10-year somewhat higher than it is now from here. But I think, and the risks certainly are to the upside next week in terms of the dot plot, in terms of the expectations laid out by the Fed. However, our base scenario is still that we might not see, one rate increase being brought forward into 2023 next year. In 2023, but I think certainly the risks are growing that we will start to see more. And if you do see even a couple more of FOMC members really sort of raising their expectations, then the risk is for higher. But I think overall, our view is that we won't see anything dramatic next week, but going through for the rest of the year, we will see yields continue to drift higher, and we will start to see more messaging coming through, whether it's next week or whether it's in Jackson Hole. It remains to be seen, but I think the risks are maybe not so much, a dramatic rise, but we will see it eventually this year.
Gene, what's your view?
Well, I think, Marilyn's right that, the Fed is now talking about tapering, and talking about tapering involves a conversation of defining what is substantial further progress in the labor market. They could come out and surprise us and be more comfortable with the progress that we've already made. And that is sort of a plausible outcome. What we've seen so far is when we see days in the market when the Fed is talking about paring back its asset purchases, we do start to see inflation expectations fall, and we start to see real yields increase. I think that'll continue. And I think inflation at this point is, ultimately driven by sort of two things. One is psychology, and the other is power, pricing power. On the psychology side, we've seen inflation expectations rise, but recently be stable. And even in today's University of Michigan survey, inflation expectations came a little bit lower. From a pricing power standpoint, I think that's critical. I think that's what the Fed will be looking at. We hear from the companies that our analysts talk to that they believe they have the pricing power to pass through higher input costs onto consumers. We've seen that so far. The question is, does that continue as we get into the fall?
Bob, just going back to you, because I know that you think that the bond market is not necessarily an accurate barometer of the true inflationary pressures. I want to understand better the international aspect of the U.S. bond market, the fact that foreign buyers have been coming in. We saw those auctions of 10-year and 30-year treasuries this week that went phenomenally well. There is plenty of bid, and you've got the ECB and other central banks firmly on hold, remaining as dovish as they can be. There is a question of whether U.S. yields can rise even if there is inflationary pressures that pick up more substantially. Or are we going to see more negative real yields, given the fact that, honestly, the international picture is just a low-yielding one?
Well, Lisa, you're right. The central banks globally are ganging up on the Treasury market, and there's a lot of purchasing that then comes in from overseas. What's really missing from the conversation this time that we had back in 2009 is just how much is the 10-year yield being distorted by the amount of QE? And back then, everyone came out with about 100 basis points. And I think that was about right. They're doing 1.5 times the amount of QE today that they did back in 2009, 2010. I think the entire yield curve would be up about 150 basis points from where it is today if the Fed and the other central banks weren't in the market and they left it to us bond investors to price it. And you can go back to 1992 and see what that looks like. How much of that is the Fed? I think roughly 3/4 of it. I think the other quarter is the influence of the foreign central banks.
Marilyn, do you agree?
Well, I certainly agree with Bob that the influence of the central banks is having a huge impact on bond yields. And if they weren't in the market, then yields would be significantly higher, given the fundamental economic backdrop. Given inflation, then certainly they would be higher. I think, going forward for the rest of this year, and if you look at other areas of the bond market as well, if you look at the performance of high yield, if you look at flows going into the loans, CLOs, securitized, then I think the bond market is showing that investors are moving into other areas of the market where there's just this insatiable demand for yield and for carry, whether it's from investors coming from abroad or whether it's for domestic investors who just have these liabilities that they need to match, they need to find this carry. So I think the bond market is being significantly distorted, and that's certainly correct.
Well, we want to elaborate on the picture in the credit market, especially as junk bond yields fall to near record lows. We're going to get there in just a second. Everyone's sticking with us. Coming up, we're going to talk about those junk bond yields, which are hovering at record lows. Investors continuing to rush to new issues in the primary market. Those new issues coming at a record pace. That conversation coming up next. And this is Bloomberg. This is Bloomberg Real Yield. I'm Lisa Abramowicz in for Jonathan Ferro. Time now for the auction block, where we kick things off here in the United States with strong demand for 10-year papers, stealing the spotlight from a slew of Treasury auctions totaling $120 billion. U.S. investment grade supply pushing past dealer expectation this week. High-grade issuance nearing $36 billion in the wake of the Fed's decision to unwind its corporate credit facilities. And rising consumer prices stoking the fire in junk bonds as the riskiest debt heads straight for a third straight week of gains. It also was another blockbuster week of auctions with a sale of a $500 million junk bond offering, with proceeds going to buy Bitcoin. Marilyn Watson, Bob Michael, and Jean Tannuzzo still with us. Jean, what's your view when you see something like that MicroStrategy bond, the $500 million offering, with the proceeds being used to buy Bitcoin?
Well, look, there's definitely froth in the market. We can see that, this morning, I think high yield bond yields are plummeting the lowest levels we've ever seen. I think it speaks to the backdrop that we've all just talked about, which is, central banks are causing yield to evaporate from the markets, and investors are rational actors, and they're finding yield wherever they can find it. At this point, there's a shortage of income-producing assets, and high yield as an asset class has been a beneficiary. And it's been in a bit of a sweet spot because fundamentals are strong and default rates are coming down, and they're coming down very quickly. It's amazing in an asset class like high yield how adding liquidity to the market and allowing companies to roll their maturities and extend their maturities really can reduce the default rate. And I think we've built a bridge to get us to the COVID recovery. We're now in that recovery. Earnings are improving. Default rates are coming down. So I think investors have become comfortable with high yield, but history would tell us that investing in high yield companies, particularly triple Cs at these credit spreads, tends to have a bad outcome if you're holding for more than 12 months. Okay,
so in other words, you're still holding and potentially even buying, but short term. Is that correct, Jean?
So we've been reducing, and we've been very cautious, particularly in that triple C segment. What we own there tends to be significantly under yielding the broad market, trying to focus on better quality companies. And if anything, in the high yield space, we would prefer shorter maturities, and we'd prefer leveraged loans as a higher quality alternative.
Bob, what's your view?
Yeah, let me start out by saying, sure, like everyone else, I wish I could buy high yield at 6 to 8%. I can't. It's at 4%, and credit spreads are just over 300 basis points. I'm hanging on for dear life. I think credit spreads are going at least 75 basis points tighter on high yield. We've done a lot of work on the high yield market. We've done a lot of work on recovery rates. I think a lot of our clients are surprised that some of the travel and leisure companies from a year ago that went through restructuring, the recovery rate was over 100 cents on the dollar. Credit spreads in high yield don't blow out for real unless there's a recession imminent. And we haven't even begun the normalization process. So yeah, we like high yield here. You're about to see EBITDA explode to the upside, and there's going to be some involuntary deleveraging of a lot of companies across this space.
Wait, what do you mean involuntary deleveraging? Because that seems like a credit negative. Is that a credit positive?
No, it's very much a credit positive. It means that over the last year, corporate America has filled its coffers with ultra low borrowing funding. So they've issued debts at yield levels they never imagined they could fund themselves at. So the debt is on the books, and we've seen leverage ratios drift higher. Now as the economy opens and you start to get the revenue come in, when we model what EBITDA looks like, it's a tidal wave of cash coming into these companies. So they can buy back shares, they can increase dividends, but they're going to pay down a lot of debt.
Well, Marilyn, do you agree? I mean, I hear what everyone keeps saying, which is we're in a good part of the cycle. And yet when you take a look at how tight spreads are, you see activity like dividend recapitalizations, and you see things like borrowing money to buy Bitcoin. Does that get you concerned, or it's just one of those things you kind of have to let ride?
So I think when you look at, first of all, when you look at the excess returns of high yields sort of year to date, a significant portion of that has actually come from carry, which goes back to our earlier conversations around just this huge amount of demand for carry and for yield from investors. I think along with, I agree with some of Jean's comments earlier that we have reduced overall some of our high yield allocations in our global unconstrained accounts. So we do have, we've increased our allocation to higher quality, whether it's investment grade or just further up the high yield sort of stack. In terms of valuations, they are extremely tight. And we can see that even on sort of days where we have more volatility or on idiosyncratic events, you see investors are still sort of jumping in, trying to access those little pockets of carry and yield wherever they can. So overall, we're looking at really now, I would say, from a very, very much a bottom-up perspective. We do still have allocations to high yield, but we have overall reduced them recently, and we have a much more sort of balanced and diverse allocation in terms of corporate overall.
What's been your reason behind reducing select positions, Marilyn?
So it's really based on valuations. They have performed incredibly well, year to date. And when you look at the huge amount of liquidity now in the market, when you look at what is going, when you look at the fact that the US economy is doing incredibly well, and we have been talking about maybe not so much coming from the Fed in the next few weeks, but overall we do think that eventually the Fed will, let us know that they will be tapering at some point. We are really gearing up for a continuation in the overall improvement in economic data. We're seeing, the S&P 500 is at record highs. So I just think overall, when you look at sort of valuations and where you can allocate your capital and where you can get the best sources of sort of risk-adjusted return, then overall we want to be a little bit more balanced. And so we have sort of reduced our overall in high yield and increased allocations to IG and other areas of the market.
All right. Well, you're all sticking with us. And I will say I could go for a full hour on this particular topic. I know a lot of people are wondering the consequences of the glut in corporate debt. Perhaps just more to come. Still ahead, the final spread. The week ahead featuring Chair Jay Powell and an FOMC rate decision. That conversation coming up next. This is Bloomberg. This is Bloomberg Real Yield. I'm Lisa Abramowicz in for Jonathan Ferro. Time now for the final spread, the week ahead. Coming up, a slew of economic data and monetary policy decisions. PPI from the U.S. and retail sales coming out on Tuesday, followed by initial jobless claims on Thursday. Plus, we get a Fed rate decision and Chair Powell news conference on Wednesday. Then, central bank rate decisions from Indonesia, Norway, and Switzerland on Thursday. And it's the Bank of Japan's turn, closing out the week on Friday. Still with us, Marilyn Watson, Bob Michael, and Jean Tannuzzo. Jean, I'm wondering, when we talk about the central banks next week, everyone focused on the Fed. Do you expect any news out of them, considering the fact that they've got the market exactly where they want it?
Well, I think the market's where they want it for now, but they are going to be talking about tapering. And, I think that's important not just for Treasury assets, but for all fixed income assets. We're going to be moving through a timeline here where I think, June and July meetings are really about understanding what it means to have substantial further progress in the labor market. We're still about 7.5 million jobs below the pre-pandemic peak. I think as we get into Jackson Hole, we're going to start be having a more academic conversation if they're pleased on that progress. And I think that's when we can start to, see an announcement of what a taper will look like. But even that taper is probably not going to happen until early next year. So, I think there's going to be little new news in the statement, probably none. And it's really going to be the evolution of the press conference and the line of questioning, really around how soon can we see this change in asset purchase behavior.
And then there's a question, Bob, of whether the Fed's already behind the curve and whether by design they're going to make a policy error down the line when they have to raise rates too quickly. Do you think that's the case?
there's no question as to whether they're behind the curve. They're so far behind the curve, they can't even see it. And they're telling us that that's their intentional plan. Look, if I were the Fed, you're going to get a lot of questions, pal, at the press conference, and I would start the conversation on tapering. There's a lot of growth. Inflation's very high. You're kind of rolling the dice thinking it's going to be transitory. The oil shocks in the 70s proved to be transitory. It doesn't mean that it didn't have a big impact on the economy in the meantime. I think there's too much distance and time between this FOMC meeting and Jackson Hole, and a lot more economic acceleration could happen in the U.S. and globally.
All right, and Marilyn, before we get to the rapid fire, just 20 seconds. Do you agree they're so far behind the curve they can't even see it?
Well, I certainly think they are behind the curve, and as Bob said, it's intentional. So the Fed have made it very clear that they're willing to let inflation run hot because they do have this dual mandate.
Yeah.
As Jean mentioned, then the unemployment rate is still nowhere near where their target rate is. They do have this dual mandate. They want to support the economy as it comes out of this pandemic. They want to support the labor market. And so they're willing to let inflation run hot. And I think that's certainly the case.
All right. It is that time, the beloved time, where we start talking about the rapid fire questions. I'm going to give them to you, and you have to answer in short order. First one, when will the Fed start tapering monthly bond purchases? This year, 2022, 2023, or never? Marilyn.
2022.
Bob.
Jan 2022.
Jean.
I got the over on both of those, but let's say end of the first quarter, 2022.
All right. Now, 10-year Treasuries right now, buy or sell? Marilyn.
Sell, neutral.
Bob.
Sell them to the Fed.
Jean.
I'd rather sell tips.
All right, we're out of time, unfortunately, but we will have another rapid fire, and I will call you each on it. My thanks so much to Marilyn Watson, Bob Michael, and Jean Tannuzzo. From New York, that does it for us. This was Bloomberg Real Yield. From New York, this is Bloomberg.